Everybody, welcome back for another video. I'm Jerry Aliberti, owner of Pro-Accel. Today I got a special guest with me. His name is Travis Mayer. He is a construction financial lending and cash flow specialist. Travis, thanks for coming on, man.
Absolutely.
Appreciate it. So in today's video, we're going to talk about several topics about financial lending in the construction business. We're going to talk about the types of financing available. When should you consider financing? Who's it for? What to be cautious about? And also, how can contractors protect themselves so they don't lose everything, including their homes and their kids' college education, which I often hear about. And it's pretty sad, but that happens more often than people may think. And I think you'll agree with me on that, Travis, based on the many conversations we had. So,
Yeah, it's a
yeah,
risky game.
it is a risky game. So, Travis, quickly, why don't you just kind of explain your background, how you got into this fantastic business of the roller coaster of construction.
Yeah, been in the industry for almost 10 years now. Got my start out of college, knocking doors here in Texas, heat, selling roofs, storm damage areas, so door to door. Worked in some various big name manufacturers in the supply chain space. Working with builders and contractors on that side, and then got into the kind of the overall business consulting financial side, specifically to subcontractors, and been doing that here at Build for a little over 3 years now.
Nice, awesome, and that's how I met you. Again, Travis and I met through LinkedIn. We started following each other, and then a mutual friend of ours introduced us. So it's the power of networking. And I'm sitting in New York. Travis is in Texas right now, and here we are. We're collaborating. So Travis, let's start getting into it, man. Why don't you explain the types of financing for a contractor, especially in the growth stage, who doesn't have that big, large bank account? You mentioned to me a couple of weeks ago that the average contractor has 6 weeks worth of cash stashed away. So why don't you talk about the types of financing contractors have available?
Yeah, and that 6 weeks would be on the high end for most. So
Yeah.
you know, it depends on the stage of your business, right? If you're a contractor starting out, even if you've got years of experience at another outfit and you've been in the trades and on the front lines for a long time, the way that debt institutions or finance institutions look at business history and credit reporting and everything that they consider from a risk perspective, you could have all the field and business knowledge in the world. And in their eyes, it's zeros and ones for the most part. And so you're less than 2-3 years in business. Not, your tax returns are low margin work compared to their other portfolio. And you're trying to get that $50,000 line of credit to get started, and you're getting told no, right? And you would think, I hit 1 million or 2 million in revenue, things are going to change. Banks are going to call me. Suppliers want to work with me. I'm going to work with better contractors who pay better. If you're growing at all, regardless of your revenue, the same cash flow management and finance cash flow management challenges exist. The same working capital options exist. There's just more zeros in all of your columns. So my $5 million client trying to get to 10 million is not very much different from my $50 million trying to get to 70, right? And so you have your cash, traditional, most flexible line of credit. So a traditional finance institution bank, I recommend local regional banking partners who may have a team that has construction in their portfolio already, so that they know what they're looking at a WIP.
Absolutely.
Business credit cards, right, which aren't enough to operate the business with, but they will assist with miscellaneous spending, credit reporting, extending terms in some cases. Then you have alternative financing that's construction industry specific. That's something like Build. There's some other things out there that have entered the space in the last 5 or 6 years. And then you have, what we would consider bad debt, payday loans, predatory in nature, MCAs or merchant cash advances is another example of that. And they're a very short-term solution to a major problem in the business that can spiral or become a bigger problem. And then outside of those traditional options I just mentioned, you have SBA loans, you have different government options, you have COVID and PPP. So there's always different things that are coming out based on, what's going on in the government and macroeconomic trends. And so, but as far as operating the business, most typically cash, lines of credit, business credit cards, alternative, and alternative financing are the four main options.
Yeah, and the biz credit cards, I know it's just as easy as pulling out a credit card and then just start swiping, right? Where you got those high interest rates but one thing I want to bring and I want to shed light on is obviously when you're an entrepreneur, you always try to reduce your tax burden at the end of the year, right? And when you reduce your tax burden at the end of the year, a lot of accountants like to pound their chest that they got their client, a construction business owner, showing that they made a loss. Meanwhile, they didn't really make a loss, right? And now you go and you hand off that return to a financial institution or a bonding company that wants to see that you're making money, and it actually hurts you in the long term. So what are your thoughts on that, right? So an accountant shows that you're making a loss when you're really not making a loss. What do you need, being a financial professional, financial lending pro, what do you need to know and understand about a contractor before you actually start lending money to them?
That's gonna vary based on the lender, right? And that's why I said a local regional banking partner for a traditional line of credit and treasury accounts depository is what we would recommend to contractors, because you need to have a relationship with your banker, and your banker needs to have a damn good relationship with the underwriting team behind them. Because when you look at a tax return of a subcontractor, and when you look at a WIP and progress billing and why your AR aging is 60 to 90 days and what retainage even means, if I'm an underwriter with no construction experience on the other side of that table, reviewing that is a risk profile I don't understand and I don't want anything to do with, right? And so, you have to, from the sub side, you have to have a plan. If you are 5 million and you say, I want to get to 10 and I don't really want to manage that many people, that plan looks very different than a $5 million revenue client that wants to get to 100, right? The short-term benefits of hiding the money, so to speak, to reduce your tax burden for that guy that wants to get 10 million, maybe that is a better option for them and their goals and their family and their business. But if you know that you're going to need capital options now and in the future, you need to have that plan years in advance so that you aren't necessarily trying to reduce the tax burden. You're showing the numbers and the story and the picture of where you want to be and where you're currently at, as opposed to kind of working against yourself in some cases.
Yeah, no, those are great points. Thank you. So moving on to the next topic, when should you consider financing? I know you slightly touched up on it, but when should a contractor consider financing?
Yeah, so part of the plan, right? You got to have a plan, but in being financially stable, isn't only about how much cash you have in the bank. It's about your cash flow, it's about your working capital options that you use, and then your overall plan. Where do you want to get? How quickly do you want to get there? And what do you need to achieve it, right? So having a working capital stack that includes, financing such as lines of credit, material financing, supplier terms, using your own cash. You pull all these resources of capital based on your business's specific needs and goals. So when you're using strategically, right, financing can help you accomplish many things, right? Diversification and expansion of your access to capital, right? So I have more flexible options to use in more various ways. Profitable business growth, right? We talk about good debt and bad debt all the time. Good debt can be considered at a super high level. Anything that I can get a return on, right? Is this type of leverage good? Can I use this money? Can I take this dollar to go make 5, right? So profitable business growth in a healthy manner is a great use for financing. And you look outside of construction, it blows people's mind outside of construction just how little debt is leveraged, or just debt in general is viewed in the construction space, right? You go look at a tech company or any other company outside of construction, a manufacturing company. They are going to leverage good, responsible debt to fuel growth, within the business. And even when macroeconomic conditions change and rate hikes aren't coming down like everybody was promised, and everybody's kind of clutching their pearls and their cash, you still can leverage good sources of debt to achieve different efficiencies, even if you're not in hyper growth mode. You're not trying to grow 30% year over year. Great. Go make that key hire, pay them $30,000 above the market, and do your best to build a culture and retain the talent that you have. That's a good use of capital investment, right? So it doesn't necessarily have to be growth, but whatever the various initiatives and goals are of the business, how are you stacking your capital options to streamline and achieve those, right? Financing can be used to build better relationships with suppliers, GCs, clients, right? If you are in a position to, pay suppliers in a more timely manner instead of paying them when you get paid, right? You can take priority on inventory, you can take priority on service. So you can build better relationships with everybody in your ecosystem by managing your finances a bit different as opposed to the industry standard, right?
Right.
And then the last one, increase operational efficiency, which I hit on a little bit, and risk management. How do I stack my available capital options to mitigate risk in my business, insulate my cash, insulate whatever I can around my long-term plan? And then where do I make strategic investments to achieve greater operational efficiency, right? You're an operations guy. You've got the playbook on everything that you need to do from an operations standpoint to scale, grow, streamline. Some of it takes money, right? So if you had more of a budget to do some of those things, how much more quickly could you make some of those operational improvements?